You've paid off your debt, you have a good emergency fund, a growing retirement account, and even a little more cash. What's next? Big things have small beginnings, and $1,000 is enough to start investing. Cash has many advantages, but once you've paid off most of your debt and your emergency fund is available, investing some of your money can increase your chances of growing over time. In today's video, we'll see how to start investing with $1,000 or less. But before we move on to that, make sure to subscribe to our YouTube channel, tap the bell icon, and smash that like button. Now, let's get started. When you are financially strong and have little savings, it is time to start investing your money. Even if you are an inexperienced investor and are averse to taking risks, remember that by starting early, you can start building your investment skills. Before diving in, consumers should remember that investing is usually a long-term game. Once the money in stocks and bonds is compromised, it can be lost. Therefore, the funds needed to pay bills or cover emergencies should be kept in cash. However, here's an overview of how you can invest when starting with $1,000 or less. P2P Lending. P2P lending websites connect borrowers directly with investors. Each website sets rates and conditions and allows transactions. Most websites have a wide range of interest rates based on the creditworthiness of the applicant. First, an investor opens an account on the website and deposits a certain amount of money to be divided into loans. The loan applicant publishes a financial profile assigned a risk category that determines the interest rate that must be paid by the applicant. Loan applicants can review and accept offers. Some applicants split their applications into sections and receive multiple offers. Transfers and monthly payments are processed through the platform. The process can be fully automated, or the lender and borrower can choose to negotiate. Invest in an ETF or index fund. Exchange-traded funds and index funds are great ways to invest for relatively small amounts of money. The advantage of these funds is that they are very transparent investments. You need to know about a particular ETF or index fund, including holdings, commissions, and expense ratios. You can also choose the best broker to buy ETFs from the best ETF brokers. An index fund is essentially a broad-based passive market investment across major indices, while an ETF can offer more opportunities to customize a portfolio. With $1,000, you can collect ETFs with different risk profiles. For example, you could divide the money into a high-risk ETF at $250, a dividend ETF at $250, and place the remaining $500 in a bond ETF. Or you can reverse the mix or even invest in an ETF to grow. It all depends on your time horizon and risk tolerance. Trade options and Forex. There is a big difference between can and should when it comes to investing $1,000. $1,000 can be used to open online options or Forex trading accounts, and yes, this account provides a way to use that money to earn huge returns in no time. But just because you can doesn't mean you have to. Of all the investments we've looked at, trading Forex and options offers the highest risk and the highest chance of losing all your money in a short period of time. Of course, there are plenty of people who can handle $1,000 and earn solid returns based on their experience with various trading strategies, while also controlling their risk. Some people might get lucky and multiply their money by trading one currency on a hunch. However, many of these traders are likely to lose $1,000 or more just by learning to trade. At least give this type of simulated trading a try before risking your hard-earned money. Invest $1,000 in a single stock. Now we're going to take a look at some investments that you wouldn't recommend to your grandparents. They require a higher risk tolerance and more research, but they also offer a great potential for your $1,000 return. This is for the type of person who likes to scream, "I'm in it" in poker. $1,000 is enough to make any stock purchase through an online broker mean. You lose some money in the transaction itself, but providing it properly can double the transaction costs. There have been a few points over the last 5 years where an investment in Meta, formerly Facebook, Apple, Netflix, or Google, would have doubled or tripled your $1,000. The trick is that you have to be in the market and be aware of the advantages. However, researching stocks and investing $1,000 in them can work. Of course, you could lose money or get a lower return on an ETF investment that has the same stock as part of the mix. Invest in low-risk debt instruments. The above mutual funds usually have a higher risk and reward profile than investments in debt security. If your primary goal is to maintain $1,000, not increase it, then investing in debt may be your best choice. Certificates of deposit and saving bonds are not the most attractive ways to invest $1,000. However, they have the advantage of very low risk and modest returns. There are direct bond offerings from companies that offer much higher interest rates, as well as bond ETFs, but both require a bit more research and a lot more risk than simply investing $1,000 in US Treasuries. Invest with RoboAdvisor. With $1,000 investment, the costs associated with active management can be hard to swallow, especially since productivity often lags behind passive index or ETF options. However, robot advisors such as Betterment, Acorns, and Asset Builder have entered the market active management offering at a lower cost compared to the price of human fund managers. Some of their suggestions allow you to take advantage of active management, particularly rebalancing the portfolio more frequently during market events without paying traditional prices. What to consider before you invest? Investing isn't for everyone, and your decision about whether it's right for you, and if so, where and how to do it, will depend on a number of factors. Your current financial situation. When you invest, the value can go down as well as up. The tighter your budget, the less comfortable you will be with losing money, and this will affect the type of investment you choose. Ask yourself, can you lose it? Your risk level. Everyone has a different tolerance for risk, and knowing what's yours will influence the type of investment that's best for you. If you are unsure or concerned about the potential loss of your money investment, it may be worth seeking financial advice from a consultant who will use a special questionnaire and suggest the right type of product for you. Your time frame. When do you need to use the money? Some types of investments are more volatile than others, although they can do well over time, but still it's a bad idea knowing you're going to need the money in a relatively short period of time. Those who don't need money for decades after retirement are usually able to take on more risk in the hope of higher returns. While it's not a huge amount of money, it's well worth the $1,000 to invest. Many of the options we considered, especially ETFs, are worth investing $50 or even $20 on a regular basis. It is worth repeating that investing in a gradual game. You are unlikely to rise to become an independent rich person with an investment of $1,000. On the other hand, a $1,000 investment can help you with financial security and, as a side benefit, expand your financial education. This was all about today's video. If you found this video helpful, make sure to give it a big thumbs up. And do not forget to subscribe for more content and press the notification bell so you never miss any updates. This also helps us grow our channel so we can continue to provide value to our audience. Also, let us know your thoughts in the comment section below. Thanks for watching.